Health Savings Accounts HSA's Insurance Exam Prep. Question 1. To contribute to an HSA, an individual must be covered by a HMO, PPO, High Deductible Health Plan, HDHP, FSA. HSAs are strictly paired with High Deductible Health Plans, HDHPs. Question 2. What happens to unused HSA funds at the end of the year? They are forfeited to the employer. They roll over to the next year. They are taxed as ordinary income. They are donated to charity. Unlike FSAs, HSA funds do not have a use it or lose it rule. They roll over indefinitely. Question 3. HSA contributions made by an individual are taxable, tax deductible, subject to a 20% penalty, only allowed after age 65. Contributions made by the individual are tax deductible, above the line deduction. Question 4. What is the penalty for using HSA funds for non-qualified medical expenses before age 65? 10%, 15%, 20%, 50%. Non-qualified withdrawals before age 65 are subject to income tax plus a 20% penalty. Question 5. After age 65, what happens if HSA funds are used for non-medical expenses? 20% penalty applies. 50% penalty applies. The funds are tax-free. They are taxed as ordinary income without a penalty. After age 65, the 20% penalty is waived, but non-medical withdrawals are still taxed as ordinary income. Question 6. Which of the following is not a qualified medical expense for an HSA? Prescription drugs, cosmetic surgery, dental care, vision exams. Elective cosmetic surgery is generally not considered a qualified medical expense. Question 7. True or false, an individual enrolled in Medicare Part A can continue to contribute to an HSA? True, false. Once enrolled in any part of Medicare, an individual is no longer eligible to contribute to an HSA. Question 8. Individuals aged 55 and older can make additional HSA contributions known as rollover contributions, catch-up contributions, matching contributions, excess contributions. Catch-up contributions allow those 55 plus to contribute an additional amount, currently $1,000, annually. Question 9. Who owns the funds in an HSA? The employer, the insurance company, the employee/individual, the federal government. HSAs are portable. The individual owns the account even if they change jobs or health plans. Question 10. True or false, HSA earnings, interest/investments, grow tax-free? True, false. Funds inside an HSA grow tax-deferred and are tax-free if used for qualified medical expenses. Question 11. Which of the following can contribute to an employee's HSA? Only the employee, only the employer, both the employee and employer, only the health insurance provider. Both employees and employers can contribute, up to the annual IRS limit combined. Question 12. Employer contributions to an employee's HSA are taxable to the employee, not included in the employee's taxable income, deducted from the employee's paycheck post-tax, subject to FICA taxes. Employer contributions are treated as employer-provided coverage and excluded from the employee's gross income. Question 13. Can HSA funds be used to pay for long-term care insurance premiums? Yes, subject to IRS limits. No, under no circumstances. Only if the insured is over 65. Only if the policy is an HMO. HSA funds can be used for qualified long-term care premiums up to IRS specified limits. Question 14. What is a key difference between an HSA and an FSA, flexible spending account? FSAs require an HDHP, HSAs have a use it or lose it rule. HSAs are portable and roll over. FSA limits are higher. HSAs are fully owned by the individual and roll over year to year, whereas FSAs typically forfeit in used funds. Question 15. If an individual has dual coverage, an HDHP and a non-HDHP, can they contribute to an HSA? Yes. No. Only a prorated amount. Only with employer approval. To be eligible for an HSA, an individual cannot be covered by a non-HDHP, with limited exceptions like vision/dental. Question 16. Are over-the-counter, OTC, medications eligible for HSA reimbursement? No, never. Yes, but only with a doctor's prescription. Yes, without a prescription, under recent law changes. Only if purchased at a hospital. Under the CARES Act of 2020, OTC medications are now eligible HSA expenses without a prescription. Question 17. What type of deductible must an HDHP have compared to traditional plans? Lower, higher, zero, variable. As the name implies, a high deductible health plan requires a higher minimum deductible set annually by the IRS. Question 18. If a person makes an excess contribution to an HSA, what is the consequence? A 6% excise tax per year until corrected. Immediate loss of the HSA. A 20% penalty. The bank automatically rejects it. Contributions exceeding the IRS limit are subject to a 6% excise tax for each year they remain in the account. Question 19. Can HSA funds be used to pay COBRA premiums? Yes. No. Only if the employer matches. Only for the first month. HSA funds can be used to pay health insurance premiums while receiving unemployment benefits or under COBRA. Question 20. True or false, spouses can have a joint HSA account? True. False. HSAs are individual accounts. However, family funds can be used for the spouse and dependents.